And hi, everyone. My name is Okwemi Luchulo, and I will be serving as the moderator for today's conversation. And basically, we'll be exploring how development banks can support sustainable, resilient food systems. And basically, my role as the moderator is to guide the discussion, keep us on time, and of course, help us draw connections between development finance, agricultural policy, and the broad transformation of global food systems. And just to give perspective to what the next 85 to 90 minutes is going to look like, following this welcome address and agenda setting that should last for about 10 minutes, then we should pass the mic to our panelists who would be presenting to us for about 10 to 15 minutes each. So a total of about 30 to 45 minutes, and then would transition to the guided discussion, and of course, alongside the question from the audience. And after that, we should also last for about 15 to 30 minutes. And after that, we should have the last 5 minutes for closing remark. But then just to give a brief perspective to why this conversation matters to us. We strongly believe that we are having this conversation at a time when major institutions, the major financial institutions, are beginning to rethink their role in shaping food systems. And for those that are following new developments within the World Bank Group, you'd know that just last year, the group pledged to double its agricultural financing to a tune of about $90 billion annually by 2030. And more recently, it announced its AgriConnect initiative, which is also aimed at strengthening agricultural investment. And at the same time, there is this growing recognition that simply scaling finance is not enough. The critical question, one major question that we need to ask ourselves is, what kind of food systems are these investments actually supporting? I mean, are they supporting industrial agriculture models that continues to drive deforestation, contribute to emissions, drive biodiversity loss or land degradation, or are they now helping to build and scale sustainable food systems that support nutrition security, climate resilience, biodiversity protection, and equitable livelihoods? So today, the discussion brings together leading experts that are working at the intersection of food systems transformation, climate and biodiversity finance, and development policy. And we shall be exploring, together we'll be exploring a number of questions around how development banks can support food systems transition at scale, the kind of policy and financial reforms that are needed, and we'll also be talking about the role that civil society and policy framework can play in shaping this investment. And lastly, we shall also be addressing questions around how can we avoid oversimplified solutions, such as treating the carbon market as a silver bullet for transformation of our food systems. Next slide, please. Yeah. And so with that, it is now my pleasure to turn to our outstanding panel of experts for their presentation. As mentioned earlier, the presentation from each of them would last for about 10 to 15 minutes. And this is also the right time to also remind you that please, as you follow the conversation, use the Q&A button to sort of drop your questions. And if you have targeted questions for any of the panelists, please also indicate that. And if you can make the question concise as much as possible, so that we'll be able to take a lot of questions, that'd be good. So in the interest of transitioning to our panelists, the first on my list is Nikki Mander. And just by way of introduction, Nikki is the Chief Strategy Officer and Director for Africa at Nature for Justice. And our work centers at the intersection of climate finance, biodiversity conservation, and equitable development, with a particular focus on aligning nature and climate finance with community-centered solutions. Nikki, you have the platform, please.
Hello, everyone, and thank you very much, Opeyemi, for the introduction and obviously also the opportunity to share insights from our work at Nature for Justice. Next slide, please. So I'm going to talk to you today about the carbon markets and how they can play a role in driving regenerative agriculture transitions at scale. Nature for Justice works all over the world, building and supporting community-led and indigenous-led carbon projects in the nature-based solutions space, which includes agricultural landscapes alongside natural landscapes. For regenerative food systems transitions to qualify for carbon as a potential source of revenue or financing, changes to farming practices must either increase the amount of carbon sequestered and stored in woody plant biomass like trees or in soils, or else they must reduce or prevent carbon emissions from existing farming practices. So that's what we call additionality in carbon markets. Essentially, there's a change in practice that results in us either storing more carbon or avoiding emissions. There are a large number and growing number of carbon standards, such as Vera, Plan Vivo, Gold Standard, etc., that have developed methodologies for certifying carbon removals or avoidance from different regenerative farming pathways. And that's everything from sustainable agricultural landscape management and croplands and rangelands to agroforestry, and even the production and use of biochar from agricultural residues. All of these practices can generate climate benefits. But what's important here is that they differ significantly in cost, in carbon monitoring and verification complexity, and also how quickly the carbon gains come and how quickly then the revenues appear in these projects. And that matters because carbon financing depends not just on total impact, but also on the capital intensity of these projects, the cash flow, and also the risk. Next slide, please. So what we've found is that there are many examples where carbon finance struggles as the sole adoption driver of regenerative food systems transitions. And the core challenge really is that the timing of the costs to transition farming practices and the value that is created from these transitions from a carbon perspective often doesn't line up that well. So firstly, transition costs are front-loaded. So regenerative food systems projects typically need early spending on things like nurseries, seedling production, planting, equipment, extension support for farmers who are adopting these new practices, community mobilization for scaling, carbon project certification and monitoring, reporting and verification systems. And all of this cost is happening at the same time that farmers themselves are taking yield risks as they go through some kind of a transition in their farming practices. Secondly, carbon gains and associated revenue with the carbon gains is backloaded. And what I mean by that is it can take some years for the carbon gains to ramp up and the associated revenues from those carbon credits to be generated. And often that mismatch between the front-loaded costs and the back-loaded carbon revenue means that you have a mismatch between when you need the money and when you get the money to enable these transitions to take place. And thirdly, and this is really important when thinking about who's involved in financing these transitions from a carbon markets perspective, a lot of the real value in these transitions actually sits outside of the carbon line altogether. And yet, when we develop carbon projects, all we are really expected to do and required to do is to show how much carbon revenue is generated by these projects. But things like changes in value of agricultural produce value, water and biodiversity benefits, climate resilience benefits, livelihood benefits, those things are often not captured directly in the modeling that's done for these carbon projects. And what that means is that there's often really, really good food systems projects out there, but they can look weak on carbon-only feasibility assessments. Next slide, please. So I'm going to share with you today 2 case examples of projects that we've worked on developing in the African region over the past few years. The first one is an agroforestry project in South Africa. It's a project that is community-driven, so it's on community-owned land in an area where farmers have moved out of farming because of climate change impacts. But essentially, we have worked with local communities and local government to identify 10,000 hectares of fallow and underutilized cropland with the potential to develop that to an agroforestry, regenerative agroforestry project, which would be centered on, first of all, a tree called marula, which is a native tree in South Africa. The fruit is high-value fruit from a commercial export point of view, and is becoming less available in wild harvested stocks. So the idea of introducing marula into an agroforestry system that would increase supply of an already undersupplied fruit in a market that's established was a sort of central anchor in the project. We also included avocados for export. This region is a big avocado export region, as well as other fruit trees and other annual crops for local markets and for food security at home. What we found with this project is that although from a community perspective, there was a huge interest, desire, and demand to move this forward, and clearly the livelihood benefits, the food security benefits, the inclusive economic development benefits were vast. From a carbon perspective, the rate of carbon gains was actually too slow to make this project work on financial feasibility grounds. Even though overall the project would produce about 1 million carbon credits, that was not going to be enough to actually make this project work on carbon finance alone. But what was very interesting in this example is that when we included the value of the agricultural produce that would come from the agroforestry project into the financial modeling, we found that actually this project had stacked up really well from a financial feasibility point of view, and in fact was offering a 16% internal rate of return. But critically here, about 92% of the revenue from this project came from the produce rather than from the carbon revenues. Next slide, please. So this curve is the project cash flow curve, the project I've just explained. And what you can see here is that the orange line, which is where we've modeled project cash flows, in other words, the balance between the cost of implementing the project and when carbon revenues flow back into the project and over what timeframes. You can see that the orange line is presenting a fairly weak case from a project financial feasibility perspective. In fact, the project doesn't even come close to stacking up in covering its initial costs, its implementation costs, just on carbon revenue alone. I think the costs of implementing the project was about $100 million at full scale, and the carbon revenue was only about 20 million. But the green line shows that with the fruit produce coming from the agroforestry element of the project, a very, very different picture emerges. And actually, this is a really good project from the point of view of agricultural enterprise, food systems, and livelihood benefits. Next slide, please. The second case example is also an agroforestry project that we've worked on with our partner Alabaster International in Ethiopia, in the highlands. It's a project which focuses also on about 10,000 hectares of farmland, women-headed households in the Ethiopian highlands, helping them to adopt agroforestry systems, this time centered on NSET, which is a really important food security plant in this area. It's drought tolerant. It's also used for fiber and fodder, as well as a staple during drought times. In this model, we also included coffee, which is a high-value agricultural product, fruit trees, and annual crops for household food security. The project would involve about 20,000 households with women farmers central to the adoption and implementation of the regenerative agroforestry system. And what we found in this project, a similar story. Costs arrive early in this project, and tradable carbon ramps up very slowly. And what we see when we model the carbon revenue against the costs of the project is that the benefit to cost ratio was only 0.66, which means that, again, the project was not covering its costs on carbon only. It was only really when we started to model high carbon credit prices that this project looked like it might actually stack up on carbon credit revenues alone. But again, we modeled the value of the crops coming, or the agricultural produce coming out of this project, and it again changed the picture completely. We saw that the benefit to cost ratio went up to 28.8. Break-even year came down from 21 to year 7, and the net present value was looking really good for this project. So a project like this, huge value in terms of inclusivity, social, etc., but didn't stack up on carbon alone. Next slide, please. This chart just demonstrates that same story again in the cash flow and accumulated cash flow curves, the top one being a carbon-only revenue scenario, where you can see that for a long time the project is carrying a significant cost and only breaks even at year 21. The second curve shows you that project breaks even at year 7, and obviously a lot more profitable from a revenue point of view for the farmers. Next slide, please. So what these two cases tell us is that when engaging with carbon investors and these kinds of projects, what they see is a need for a lot of capital early on. They see slow cash generation from carbon yields. They see complex carbon monitoring and verification requirements. And they see carbon permanence and leakage risk in these projects because of the involvement with community farmers, often in quite a dispersed model across the landscape. But what the food systems actually gain in these projects is something much broader and more important. It's climate resilience, it's diversification of farming systems and revenue sources, it's healthier soils and water retention, it's stronger household incomes and opportunities for inclusive women-led enterprise. And so really the challenge that we've highlighted here is not that these projects lack value and so are not investable projects. The challenge is that the full scope of the value that's created by these projects is not recognized in the financial case for carbon project investments. Next slide, please. There is a lot of differentiation between different pathways for carbon in agricultural landscapes. So the two case examples that I've highlighted here are just agroforestry examples. There are lots of other pathways for carbon finance to be used in agricultural landscapes. Some of them are a better fit for carbon markets. And a key takeaway for us has been that lower capex projects in community contexts can be a better fit for carbon financing models. So, for example, approaches like sustainable grazing or assisted natural regeneration of rangelands typically require lower upfront costs to enable the regenerative transitions, and that often makes them a better match for carbon market financing, especially when voluntary carbon market prices are still as low as they are. And this is important because many of the most transformative food systems projects are not necessarily going to be the easiest ones for carbon markets to fund alone. Next slide, please. So there is a role for development finance institutions in this space. They can play a key role in absorbing project development costs, which are often substantial in these carbon projects because of the need to comply with these carbon standard methodologies, which are really complex and require a high level of scientific integrity when developing the project. They can help to cover the early stage risk in these transitions through guarantees. They can provide concessional finance for upfront transition costs. So again, not relying on commercial financing models, which are seeking often double-digit returns and as soon as possible. They can also support proof of concept. So a big kind of barrier for us has been investor sort of low appetite for risk of untested models. So this is an area where development finance institutions can play a role. And they can obviously also help to build the institutional and technical capacity that projects need to become fully investable as carbon projects over time. In other words, they can help to bridge the gap between early public good value and later private returns from community-based carbon projects. Next slide, please. So to close, I'd like to leave you with two key messages. First of all, carbon revenue can be a critical lever for scaling regenerative practice adoption, but it doesn't always work as the sole driver, especially in more complex and capital-intensive community-based or smallholder farming transition contexts. Second, to unlock real systemic change, investment models have to reflect the full range of value being created by these projects, not just carbon. And that means stacking revenue streams and finding investment and financing models that are able to reflect all of those forms of value that these projects actually deliver beyond carbon. And I think if we do that, development banks can really help turn high impact but hard to finance food systems transitions into investable pathways going forward. Thank you very much.
Thank you so much, Nikki, for that insightful breakdown of how carbon revenue can be a critical lever for scaling regenerative agriculture adoption, and of course for highlighting how development finance institution can also play a huge role in this space. And during your presentation, I see a couple of questions coming, but we'll come back to that shortly. And in the interest of time, let me now turn to Lauren for our second presentation for today. And also by way of introduction, Lauren Baker is the Deputy Executive Director of the Global Alliance for the Future of Food, where she leads program strategy and supports global initiatives that are focused on climate, biodiversity, food security, and equity. And today she's bringing over 20 years of experience in the nonprofit, government, academia, business, and philanthropy context. And she will be discussing how we can catalyze finance and action to scale sustainable food systems approaches. Lauren, the platform is all yours, please.
Thank you so much, Opeyemi, and wonderful to be here with all of you, and in particular, Nicola and Kelly, to have this conversation. Thank you to the Stop Financing Factory Farming Coalition and the organizers. It's really an important discussion. And I also want to welcome all of you, because several of you I'm seeing on the participant list have contributed in really significant ways to the work I'll be speaking about. Next slide, please. I think we all know this, and I won't spend too much time here, but of course, business as usual is risky. Current industrial food systems are generating compounding crises. We're seeing this play out right now globally with rising fuel and food costs, rising food insecurity, food systems being the leading driver of biodiversity loss, breaching planetary boundaries. And because subsidies and finance are flowing in the wrong direction, we have these mounting high costs of this model. The FAO estimates these costs at over $12 trillion annually, which dwarfs the investment that we have in sustainable food systems. We know from our climate finance work at the Global Alliance for the Future of Food that a huge gap exists to align finance with the scale of impact driven by food systems. About 1.5 of climate finance goes to sustainable food systems, when food systems drive over a third of greenhouse gas emissions and use 15% of fossil fuels. So the current investment model right now, focused on larger scale bankable projects, can actively perpetuate the crises that institutions like public development banks are mandated to solve. The question before us today is not whether development banks and other financiers should invest in food and agriculture transitions. It's what kind of food systems those investments will build and for whom. And so what the evidence calls for are investments that move away from extractive industrial agriculture that concentrates power and wealth in the hands of a few, including large-scale monocultures, intensive livestock, input-intensive export-oriented commodity chains, and large-scale land acquisitions. These are these are the sort of drivers of the most harms, moving away from those investments toward agroecological, organic, and regenerative food systems that protect and enhance human rights, the right to food, biodiversity, and ecological services, while delivering, as we have the evidence for, on yields, livelihoods, and nutrition. I'd like to elevate one report that recently came out from the Institute for Agroecology at the University of Vermont. They did a scoping study on agroecology and public development banks. I'll put the link in the chat in a few minutes. And they looked at some of the barriers, the structural barriers that systematically undermine public development banks, aligning with agroecology and more regenerative approaches. And this is what we're solving for in our work on regenerative and agroecological transitions. Some of these barriers are investment bias toward global value chains, the bankability problem. And Nicola, I was struck by many of the similarities in terms of some of the challenges you described so clearly. Narrow narratives on modernization that reinforce top-down or more technocratic models rather than farmer-led or SME innovation, weak safeguards and accountability, and the kind of broader sovereign debt dynamics. I won't go into that, but I will share that report. Next slide, please. Thank you. And so if that's the problem and the risk, the opportunity is to think in new ways about investing in transitions to regenerative and agroecological food systems. The work that we're doing on this raft is led by a strategic collaboration of 25 more philanthropic funders, coordinated by the Global Alliance for the Future of Food, with a shared ambition to transition 50% of global agriculture to regenerative and agroecological systems by 2040. This requires a 10 times investment. But RAFT is not only a philanthropic initiative, it's a model for how different types of capital and different capital holders can work together in a sequenced, coordinated way to drive landscape scale food systems transformation and address some of the barriers that Nicola so clearly outlined. And this makes it directly relevant, of course, to development banks. And so we operate through a landscape and territorial approach. We're working in specific geographies where the conditions for transition exist: farmer demand, civil society capacity, policy alignment, and market opportunity. Rather than funding isolated projects, we're investing in the systemic conditions for transition, the kind of platforms for coordination across the ecosystem and finance, the evidence, building the evidence base, the blended finance structures, and the policy enabling environment that allow individual farms and communities to shift and stay shifted. Next slide, please. Active investment planning is underway in 6 geographies. This slide gives you a sneak peek of the work from Tanzania, Kenya, and India, which is most mature and has the most detailed transition costing. In this work, we quantified the financing gap, we mapped the investment opportunities, and so there are deployable pipelines of business and community investments that are ready for capital. We're designing the blended finance architecture, and this work is aligning with national policy frameworks, including growing momentum for national agroecology strategies that nest within the national biodiversity strategies, NDCs, et cetera. And you can see some of the priorities identified by partners that span these three very different contexts: Kenya, Tanzania, India. Training, bio-input and seed systems, local and regional market infrastructure, participatory guarantee systems, coordination and governance, research and evaluation. Next slide, please. This work, the work in Brazil, the US Midwest, and Europe has involved creating philanthropic roadmaps to support the underlying conditions for these more specific investment opportunities. And for example, in the Midwest, that work will be released next week with the investable priorities identified by a very broad group of partners in the Midwest. And I just want to elevate the importance of having in this kind of broad coalition of partners the US and Europe, because we need to turn these big ships as well. Next slide, please. Thank you. I'll just say a few words about this collaborative finance and action model that we've developed with partners along the way. And I want to say how this really addresses, Nicola, one of the gaps that you identified to bridge public value and private returns. So we identified that there are 3 pillars of finance that are required to support ambitious transitions over the next decade. The first pillar being all the work that CSOs do, farmer organizations, support research, training, technical assistance. The second pillar, transition finance, supporting farmers and SMEs, value chain actors to move through the transition. And then business investment. Right now, those investments operate in silos. They're quite fragmented. And so through ecosystem finance and market coordination, we can link and connect up these capital holders over long-term horizons to support agroecological transitions. Really key for this is building that financial architecture where people can share information and opportunities across the ecosystem. The opportunity for development banks are threefold. And these are things that are otherwise hard to find in one place for larger investors. One is investment-ready deal flows. The second is de-risking through blended structures. And the third is accountability and alignment infrastructure. The raft frameworks are grounded in the HLPE's 13 agroecological principles, drawing on true cost accounting frameworks and other frameworks that help with outcomes, reporting, and monitoring. There are many tools that are available to demonstrate portfolio level impact. Next slide, please. And so we are not asking development banks simply to add agroecology to existing project pipelines or to add regenerative projects to their pipelines. This model asks for something more fundamental, a willingness to co-invest in the conditions for transformation, not in individual transactions alone. So being present in the landscape, not just as a funder, but as a partner in governance and collective governance that includes civil society and government and funders, providing flexible patient capital. We've already heard about that, including grants and concessional instruments, to create that relational and institutional infrastructure that these transitions depend on, coordinating with other capital holders, and accepting that the returns are multidimensional in the way that Nicola also described, measured in ecological resilience, community well-being, food sovereignty, as well as financial yield. The development banks that engage with raft frameworks in particular countries find that much of the hard preparatory work has already been done. The invitation is to bring capital and institutional weight to support the leaders, farmers, fishers, entrepreneurs, policymakers on the ground who have been leading this work for decades. And I'm happy to provide specific examples. I'm sure I'm running out of time now, from India, from Tanzania, where we have these nascent partnerships across capital holders. I look forward to saying more in the Q&A, and we'll post some of these resources in the chat. Thank you so much. Over to you, Opeyemi.
Yeah, thank you so much for that, Lauren. And of course, it is a pleasure to have you on the call today as well. And of course, thank you so much for that thoughtful perspectives on how and why finance should be aligned with actions for systemic transformation. And I like that you also brought in the perspective of blended finance, which is something our next presenter would also be speaking to. And so with that, I would like to move to Kelly. And also by way of introduction, Kelly McNamara is the Climate and Nature Director at Food Systems Innovations. And she works on designing innovative finance mechanisms that support low carbon and humane food production systems. And of course, our work centers on how financial instruments, investment models, and policy incentives can accelerate transition towards sustainable agriculture. Kelly, you have the platform, please.
Thank you so much, Opeyemi, and thank you all for joining and for giving me this space. It's a pleasure to be here with my fellow panelists and all of you. So today, I'd like to share some insights around non-animal derived sustainable proteins. During the last decade or so, innovations around these foods and ingredients have been advancing across regions and development contexts. Today, these represent a here and now infrastructure opportunity that aligns with DFI objectives around climate mitigation and adaptation, food security, and inclusive growth. And I believe this presentation aligns nicely with my fellow panelists in that we're all thinking about how markets, policy, public and private finance, and sustainable food system objectives are intersecting and providing opportunities for innovative financial and other forms of support from DFIs. Next slide, please. So first, I want to make a clarification. Animal source proteins are diverse in nature and in various contexts are critical for nutrition and economic security. However, this presentation questions whether the continued expansion of factory farming is a viable or desirable way to address increasing demand for protein. While factory farming is the predominant method of meat and dairy production in high-income countries, the model has certainly gained traction in developing countries and is continuing to expand there, including with help from DFIs. The sustainable protein innovations we're going to discuss today are also relevant for high-income contexts that need to scale back overproduction and overconsumption of animal source foods. And we'll see a couple of examples from those countries that may provide a roadmap for global expansion. As the World Bank has framed it, lessons and innovations from high-income countries may help others avoid having to decommission high-emitting and otherwise unsustainable food production infrastructure. Next slide, please. So as Lauren mentioned, I think we're all familiar with some of these challenges here, but just to highlight them for a moment. Meat and dairy generate around 60% of food system greenhouse gas emissions, while occupying 80% of global farmland and delivering just 18% of the world's calories. Again, industrial production methods dominate here. Animal agriculture also drives roughly half of global deforestation and 2/3 of non-forest ecosystem conversion, which is rising on sustainability agendas across the board as an area that we must focus on in addition to forests. Livestock also accounts for 30% of humanity's freshwater footprint. And the UN has just warned us that we have entered a state of water bankruptcy. Water is a major challenge in high income and LMIC contexts. The pollution of water from industrial operations also has major impacts on eutrophication, which has knock-on effects for fisheries. Next slide, please. So we have the planetary boundary breaches and threats combining with increasing demand for protein. And by 2050, the demand for animal source food is projected to increase 70% from 2010 levels. And numerous studies have pointed out that efficiency gains in industrial systems simply cannot close that gap. So next, we'll turn to some innovations that can help sustainably address this demand. Next slide, please. There are 3 sustainable protein platforms we'll focus on for the rest of the presentation. The first are plant-based proteins. This includes everything from pulses and legumes to plant-based meat and dairy analogs. These are commercially proven, globally scalable, and showing signs of traction in LMICs. The second is precision fermentation, which uses microorganisms to produce specific functional ingredients, so proteins, fats, enzymes, that are functionally identical to animal-derived versions. While still scaling, These are finding their ways into supply chains and easing some of the environmental pressures and enhancing supply chain resiliency. Also, biomass fermentation, again, using protein-rich microorganisms as food or ingredient biomass, so not differentiated. These biomass fermentation facilities are co-locating with existing agro-industrial infrastructure to produce affordable and high-quality proteins at scale. Important to note that biomass and precision fermentation technologies require various carbon-rich feedstocks, such as sugarcane juice, sorghum, cassava starch, or agricultural residues. And it's important to note here that across all these platforms, smallholders can serve as very important decentralized suppliers of inputs. Next slide, please. So sustainable proteins aligned with climate mitigation and adaptation objectives, circular frameworks, including in the case of fermentation that turns agricultural residues into proteins. They align with food security and nutrition objectives and inclusive growth priorities. And the institutions on this slide are providing both research and direct support for expanding sustainable protein infrastructure. But here it's important to note that scaling sustainable proteins, including proprietary technologies, capital-intensive infrastructure, and urban-centric business models, may inadvertently entrench inequalities and vulnerabilities in the agri-food system. And avoiding this will require early and deliberate inclusion strategies that center smallholders and communities. And DFIs have a very important role to play there in shaping how this ecosystem develops. Next slide, please. So I'd like to look at 6 investment pathways, taking these in order. So the first is investments in direct innovation, giving an example here from Essential Impact in Kenya that we'll take a little bit of a closer look at in a moment. So Essential Impact, it uses biomass fermentation and agricultural byproducts to produce affordable, high-quality protein in sub-Saharan Africa. This is an indoor, year-round, climate-resilient production. It addresses acute malnutrition, creates local jobs, and reduces dependence on costly imported proteins. We're going to take a closer look at Essential Impact in a moment. So the opportunity for DFIs here is direct investment combined with technical assistance to help navigate regulatory approval and integration into public nutrition programs. The second are global partnerships. This can be global North, global South partnerships. In this case, the Every company based in the US and Grupo Nutresa have entered into a partnership involving fermentation-based animal-free egg proteins, integrating these into regional food manufacturing in Latin America. These animal-free egg proteins have a lower environmental footprint and higher supply chain resiliency than conventional eggs. Again, the entry point here is blended finance and technical assistance to regional food companies, many of which are already in DFI portfolios. And the third is plant-based infrastructure. So Hero Foods is an example here of plant-based meat and dairy at commercial scale. This was for European markets, but the reason I've highlighted it here is that it was financed in part by the EIB, and that financing model is replicable in other contexts. Next slide, please. So a fourth pathway here is climate finance de-risking, and Enough provides an example here. This again, global North-based company with potential for an LMIC context. Enough uses mycoproteins, zero-waste biomass fermentation, is co-located with industrial facilities. And again, the role for DFIs with such a technology would be to mobilize capital for manufacturing facilities and supporting the global technology transfer. The fifth here is procurement-led demand. So one example was supported by the Consultative Group on International Agricultural Research, or CGIAR. And it's a school-based procurement program in Rwanda involving sourcing biofortified pulses from local smallholders. The objectives here include improved nutrition, support for local production, and nitrogen-fixing crops. And the opportunities for DFIs is to finance the upstream pulse value chains and use institutional demand to crowd in private investment. these such procurement policies and frameworks are also taking hold in other contexts where nudges, dietary shifts can have major impacts on sustainability, local food production, and nutrition objectives. And last is shoring up institutional and regulatory capacity. And Ethiopia's national bioeconomy strategy provides an example here. The strategy prioritizes fermentation and plant-based foods at the national level. And in addition to providing technical assistance to the development of such frameworks, DFIs can help convert political commitments into investable project pipelines. Next slide, please. So here I wanted to take a moment to highlight Essential Impact because their work has been featured in recent reports I leveraged today, and because they're currently engaging in research with the World Bank. So Essential provides, again, affordable, high-quality protein locally without arable land or favorable growing seasons. They're using agricultural byproducts that would otherwise go to waste. They're operational in Kenya and Ethiopia, and they're led by a team with deep roots in East African manufacturing and development. They're laser focused on creating low-cost, high-quality, and climate-resilient proteins that can be integrated into products to prevent and treat malnutrition, particularly among children. If anyone would like to connect with Essential Impact, waving this flag, please let me know after the presentation, and I'll be happy to connect you with the team. They can give very specific context about what this looks like on the ground from the end and building a venture from the ground up. Next slide, please. So here I like to close with 3 concrete asks. The first is to prioritize sustainable proteins as climate and food security infrastructure. So this is treating precision fermentation, mycoprotein, and plant-based proteins as mainstream climate mitigation investments. The ask is to integrate them into climate finance pipeline, adaptation windows, and nature-based solution portfolios. The MDB taxonomies and climate bonds initiative frameworks provide some helpful guidance here. And I'd also just say, back to Lauren's point, it's not just about finding discrete bankable opportunities, but really thinking about how these opportunities are supportive in ways that move an entire agri-food system toward more sustainable practices, even if those practices look distinct or seem to be operating in parallel. We're really looking for not discrete investments, but support of the broader ecosystem, including policy. The second is to mobilize blended finance and venture debt at scale. Again, the EIB investment in Hira Foods provides an infrastructure investment example. That model is replicable across contexts. There are also opportunities to co-invest with impact funds and climate VCs, helping to crowd in private capital. And the IDB Labs Green Entrepreneurial Engine may be a helpful platform for technologies that can originate in LMIC contexts and scale across geographies, including to the global north. And the third is to support institutional capacity and pipeline development, relating to the first ask here. So again, supporting the ecosystem, including by providing technical assistance and for regulatory frameworks, including food safety standards, labeling and approval pathways, and also support for procurement policies and national strategies that can combine to generate demand and support for smallholders and small medium enterprises and women-owned enterprises that can benefit from opportunities that are DFI supported. So I'll close with just this thought, that sustainable proteins can be a critical tool for climate resilience, food security, and livelihoods across the developing world. But that potential lies not in the technologies themselves. It lies in how they're adapted, how they're governed, and how they're integrated into local priorities. And this is where development finance is a unique and irreplaceable role to play. So thank you so much for your time. Again, I'm looking forward to the Q&A.
Thank you so much, Kelly. Of course, for the practical outline of the investment opportunities that lies within sustainable protein, and of course, investments that moves towards sustainable food systems as a whole. So thank you again so much, Ab, for that. And I would also like to take a minute to sort of appreciate all our three speakers for their insightful presentations. And now we will move into the moderated discussion segment, where we will be able to explore some of the themes that came out of the presentation in depth, and of course, bringing some questions from the audience. And again, just to remind you all to please use the Q&A button to drop your questions, and where applicable, do indicate the panelist that you're addressing your question to. Yeah, so straight up to the moderated questions, and I would like to go to Nikki first. And Nikki, there has been this growing interest in linking regenerative agriculture with carbon markets. But then at the same time, we are also seeing an increasing framing of carbon market as the silver bullet for food systems transformation. Could you help speak to the risk and limitations of relying on carbon markets? And of course, what kind of safeguards could help mitigate some of these risks? Nikki, please.
Yeah, thanks, Opeyemi. I think, one of the things that perhaps is not always so evident to those who are not involved in carbon project development is actually the complexity that's involved in trying to get a project across the line, as it were, registered for carbon credit generation and trading. There is a huge focus, and rightly so, on integrity in this space. And so what that means is that the rules around carbon credit certification, monitoring, verification, and obviously release for trade are very, very complicated, and it's not easy to just kind of comply with all of that and get a project ready and able to generate carbon credits and trade them. So the reality is that what tends to happen is that it is the better organized, often larger scale, more commercial projects with already aggregated farmers that tend to be selected for carbon project development. So in other words, the easier to certify and develop projects. And so what that means is that projects that involve family farms, smallholder farmers, communities, community-owned land, etc., are really difficult to make work in line with high integrity carbon standards. And so they tend to not be selected for carbon project development. And so, we end up with this situation where we again are driving an inequitable situation here because, not everyone is getting an opportunity to participate in carbon markets. It also means that some of the largest landscapes that are important to focus on from a food systems transition point of view are going to be some of the hardest to make work from a carbon market point of view. I think one of the other things that kind of ties into this that may not be obvious to folks not involved in this space is that the rights to carbon credits link directly to land rights. So where you have communities that are suffering under unsecured land right situations, effectively there is always a question around the right to the carbon. And that means that developing projects in those spaces is very, very difficult, because obviously the carbon rights can't be assigned. Or if they are assigned, they may be assigned to government rather than the communities, which again means complexity in how we actually develop these projects in a way that ensures that the communities get fair benefit from these projects. So it is complex. As I mentioned in my presentation, carbon finance doesn't work that well for all agricultural pathways, some better than others. And I think we need to just bear in mind the complexity in this space. The other part of this is obviously carbon markets. We have a voluntary carbon market in which carbon prices are still relatively low. So agricultural projects at the moment are spot trading carbon at anything between about $5 a ton and $35 or $40 a ton. Which is actually, it might sound like a lot, but it's actually not really enough to drive some of these projects, particularly the more complex ones. We need carbon prices to be up in the $60 to $100 a ton for some of these projects to really work on a financial viability basis. Compliance markets, which are where governments have actually regulated trading in carbon credits in terms of their own commitments to net zero or emissions reductions, offer a better solution, but by no means are they any easier to get projects over the line with. So, I think the reality is this is quite a complex space. It's not easy to get carbon finance. It's not easy to get projects registered for carbon credit trading. And in fact, that also plays into a huge gap in the financing landscape, which is early stage project finance. There is not very much finance available to actually develop projects and get them certified. So with these structural issues as they stand at the moment, I think it is really, really difficult to see carbon markets as a silver bullet solution that would help us drive the transitions that we need at the scale that we need it and the speed that we need it.
Yeah, thank you so much, Nikki, for that. And of course, for highlighting the role of integrity and of course, right, in order to address the structural issues that plagues carbon market. Thank you so much for that. And I'd like to move to Lauren now. Lauren, much of your work emphasizes the need for systemic approaches to food systems transformation. But then what we are saying is many development banks investment still operates within sectoral silos in agriculture, climate, health, or economic development, rather than treating food systems as an integrated systems. Are there governance or policy frameworks that are needed to help multilateral development banks shift from fragmented investments toward a system-based approach to food systems transformation? And of course, if you could briefly touch on how global initiatives can also help align these efforts, that would be good. Over to you, Lauren, please.
Yes, this really does get at one of the most fundamental structural barriers we face, and I think we've heard it as a key theme through all of our presentations. The fragmentation that you just described isn't incidental. It's sort of how development finance institutions were built, and around sectoral mandates, siloed technical departments, project by project approvals that optimize, within categories rather than across the system. And so these actually these barriers systematically disadvantage food systems investments, sustainable food systems investments, which are inherently integrative, holistic, and multi-outcome. In terms of the governance and policy frameworks that are needed, I want to start by saying these frameworks largely exist. We have the high-level panel of experts, 13 ecological principles, the 10 elements of agroecology that have been endorsed by governments worldwide. They're explicitly integrative and holistic. We have the Committee on World Food Security. We have national food systems pathways, the NBSAPs. And so I think the challenge is to make the case that these are all nested and connected from an intergovernmental perspective. National agroecology strategies and the way that they're developing actually globally, but we see really wonderful examples in Kenya, Tanzania, Burkina Faso, and elsewhere, are designed in this whole of government, from this whole of government framework, and are cross-cutting, and also involve civil society and various ministries, not just ministries of agriculture and environment, but also social protection, environment, health. And so it's not really an absence of the frameworks that we have, it's that they remain niche within this broader policy environment. And we need to, I think, through this kind of integrated approach, make the case for them to supersede like our conventional agricultural frameworks, which are narrower. So this is the central challenge. I'll just give one example, actually, of I think where a development bank, NABARD in India, is taking steps actually to address these barriers. And they're working with our very close RAFT partner, the Consortium for Agroecological Transformation, CAT. So CAT has been demonstrating what landscape scale agroecological transition finance looks like in practice at the district, so subnational level, at the in landscape blocks across India. And NABARD's Jiva project is also a kind of a landscape initiative. It's a national initiative by India's Agricultural Development Bank. And they're explicitly investing in natural farming and agroecological transition. And so it demonstrates that even these large structurally conventional development banks can create dedicated vehicles to provide proof of concept for agroecological finance. And I think we need to see more of this kind of alignment and partnership. And where we see this really come to life is at this subnational landscape level. And Kenya is also a great example of this, where agriculture has devolved to the county level. So we have many county governments. It's very inspiring taking up agroecology, developing agroecology strategies and frameworks. And so the question and the challenge for all of us is how to bring those into the mainstream. And through this linked capital approach, I think we can do it, because we have to invest in the things that Nicola was talking about, the project preparation, building a proof of concept, so that it's ready for this work is ready for the larger investments by development banks, by bilateral and other multilateral funders, and then ultimately to create the conditions for private sector investment that is scale appropriate, that is funding this mosaic of agroecological enterprises in a particular place and country.
Amazing. Thank you so much, Lorraine. It's good to know that some of these strategies and frameworks already exist, and we only need to make a case for them. Thank you so much again for your response. And now moving to Kelly. One of the theme that came up during your presentation, which I also believe that Lauren also talked about, is blended finance as a critical lever for advancing sustainable food systems. Kelly, what do you see as the barriers to increase blended finance in this space? Over to you, please.
Yeah, thank you for this question. So it's a great question to be asking, and you're right that blended finance is often sort of thrown out as a solution to an investment gap without really thinking about the complexities behind it, and maybe why finance doesn't mobilize in the way that we imagine it could. And my fellow panelists have done a great job of talking about how these structural barriers to various types of finance exist and ways to come around them. So I hope I can make a contribution here. So it's one thing is important to remember, and I think we all know this, is that there is more concessional capital available than there's more capital available than it might appear, but there's more capital available than there are projects that are ready to absorb it. And that's not because there couldn't be a gap there. It's just because, particularly in the LMIC context, early stage ventures often lack the technical capacity to structure deals that meet DFI requirements, whether it's ticket size or environmental and social impact reviews and assessments. So the bottleneck isn't necessarily that the money isn't there, it's that there's a mismatch between the stages of the companies and the resources required to meet DFI requirements, or in some cases, even philanthropic finance, if we're talking about larger ticket sizes. The second barrier is that risk perception is in sustainable proteins is kind of lagging behind reality. So plant-based proteins are not technology risk per se. And fermentation-based proteins, again, they are sometimes treated as a frontier technology when the underlying process is decades old and very well understood. Cultivated meat, which we did not cover today, could be in a category all its own. There's lots of technology risk there. But in plant-based and fermented proteins, I think there might be a misperception of just how risky these products can be. So in part, that's a sort of a failure to really understand how these new what that seem like innovations that are actually non-innovations can integrate into supply chains. And some of that is communication, some of it is education, some of it is just lack of projects that have taken hold in these contexts. This said, this kind of lack of understanding does keep projects sidelined, and this is manifested in different ways that my fellow panelists have articulated. And the third is, and others have mentioned this as well, is that the incentive misalignment. So blended finance deals can be complex and time-consuming to structure. For a DFI investment officer that is looking at deal volume and financial returns, a complicated blended structure with a small sustainable protein, SME, and maybe genuinely just hard to justify against larger and simpler transactions. So institutions have to be a little bit more, they have to be able to use their imaginations, or maybe we have innovative finance mechanisms, or maybe within DFIs, there's special venture, I want to say like venture or catalytic funds or impact funds that don't have to have, again, the ticket sizes or the rigor or the returns on investments expectations and mandates that bigger projects can require. And I think that philanthropy has a very important role to play here. And again, I'm curious to connect also with my fellow panelists. The Global Alliance has done so much work on this, so much great work about how philanthropy can help in various ways, whether it's communication, education, technical support, enabling environments, civil society support. There's an entire ecosystem that needs to be built around various kinds of investments in sustainable food systems, including the kinds of sustainable proteins I've spoken about today. And I think that philanthropy is ready and willing, and that increased coordination among funders can really help drive some of the capital mobilization that that can really benefit food systems in the ways that we've discussed today.
Amazing. Thank you so much, Kelly. You've not only identified the barriers, but you've also spoken on the ways to addressing some of these barriers, which is much appreciated. And again, you talked about the misperception of sustainable protein and the need to increase communication and education with regards to this, which also ties to what Lauren was saying earlier in terms of making case for some of these, making the case for some of these solutions. So thank you so much for your responses. And now we'll move to the questions from the audience. And there is this question from Tiny Beam, actually one of the 3 questions they sent that I'd like to bring up to the panelists. And it reads, many governments in sub-Saharan Africa see industrial livestock as the fastest and most practical solutions to feeding their growing urban populations, and view civil society opposition as a luxury of the global north. How do the speakers address this argument? I'll leave it open for anyone that wants to respond to the question first.
Well, I'll be happy to jump in if my fellow panelists don't mind. So I can understand why, and I've heard this argument, and I think that on some level it makes sense. These factory farming models, in their ways, are tried and true. They can scale quickly. These are multinational conglomerates, can replicate their models in different contexts. And so on the surface of it, it seems like this is rapid and easy. I guess the counter argument I would say, and as the World Bank has also pointed out, that we have a problem with overproduction and overconsumption in the global north. This has been driven by corporations that were operating on their own interests without obviously thinking about the long-term impacts on the environment, on human health, on animals, on biodiversity. During the last 6 decades, we've seen an explosion of factory farming and developed economies in particular. And with that has come some of the downside costs that Lauren referred to, agricultural subsidies flowing to these systems, then making the costs of our global food systems far outstrip the value So it's 12 trillion in value, 20 trillion in costs. And so at this point, what we've seen is the massive expansion we had to cheap, subsidized, easy calories has led to a slew of problems that the global north now needs to grapple with. And as, again, going back to the World Bank's Recipe for a Livable Planet report, as they point out, where there is an opportunity to learn from the global north experience and to learn from the negative impact, the decommissioning of infrastructure that now needs to occur if we're going to come within planetary boundaries, and the very real struggles with how to reverse some of these impacts or to reverse food systems, there can be a way to intervene earlier on to provide more sustainable sources of protein and other foods to support smallholders in ways that they were not supported in developed economies. We have a big problem with this in the United States. Mass consolidation and bankruptcy among smallholder farmers is essentially vanished. In the United States, small-scale production systems. And so it seems that there's a window of opportunity to learn from these contexts and to avoid making some of the same very costly mistakes going forward.
Thank you so much for your kind response, Kelly. I see Lauren wants to go for it. Lauren, please.
Sure, I'll compliment because, of course, much of what I would say is similar. I'll take up two parts of this question, and this question was from somebody from Tiny Beam Foundation, and before this webinar, Brian Cook shared some research that Tiny Beam had supported, which I found really interesting, which is how much development banks have spent on industrial animal agriculture worldwide. So this is really important, $3.3 billion across, I think it's 62 projects. And perhaps I don't have access to the chat, but perhaps Brian can put that report in the chat for all of you to see. I think that work was focused on Vietnam, but there is a broader context here. So what I'd like to raise about this context is also just point out that there are power issues here in terms of what gets funded and what is invested and what doesn't. So I think there's two sides to this coin that I'd like to elevate. It has to be a really central part of our conversation, and institutions like the UN Development Program are starting to take up, what does power look like in the food system and why does it drive these investments toward companies that have a vested interest, of course, in seeing industrial livestock and factory farm models take root. There's a whole narrative issue there around the demand for meat, the growing demand for meat that we need to tackle in order to address this problem. I think on the other side of that is this comment here, in my view, and view civil society opposition as a luxury of the global north. I mean, in my engagement, and I think it's the people on this call here today are an expression of this. There's a very vibrant civil society movement and vibrant civil society sector in the global south that are actively challenging these investments, are pointing the way towards alternatives, developing and advocating for policy change and policy reform, and really pointing out these risks and how both domestic capital, international capital, and across that whole spectrum need to have better safeguards and work differently in order to mitigate the negative externalities of these systems. And there are multitude of examples of where current diets are very sustainable, culturally appropriate, and certainly shouldn't be displaced by these more industrial models.
Yeah, thank you so much, Lauren, for the in-depth response to the question as well. I mean, in the interest of time, just to go into the questions from the audience. And one of the questions, I believe, asked by Michael is, Most, if not all, DFIs believe that leveraging private sector investment in intensive and extractive industrial agriculture is the answer. How do we change their minds? I'd also leave it open for the panelists to chime in. And I believe this question, okay.
I'll come in and just give my few pennies worth there. I think, and the other panelists have raised this already, is, one has got to also think about carrying capacity, environmental carrying capacity. Sometimes these systems require more water and more ability to treat waste outputs than our ecological systems can carry. And I think believing that the only farming systems that work are industrialized farming systems will just simply take us on the path of more unsustainability. We already sit in a situation as human beings on this planet where we are taking more than the planet can sustain. I think Kelly mentioned the planetary boundary theory, which I think many of the people on the call will have heard of. So, certainly if we are looking at investing in agricultural economic development, agricultural systems development, food systems, one has really got to think quite carefully about the full life cycle cost of the model that you adopt and what is sustainable from an environmental carrying capacity point of view.
And I'll just add one sign of hope and concrete sign of hope that has been pointed out. And we've had some engagement with this platform through our work at the Agroecology Coalition, where we've been supporting, convening donors, philanthropic, bilateral, multilateral, and some of the development banks over the last years to build the kind of relationships I talked about across capital holders. And there is an Agri-PDB platform, which is hosted by IFAD under the Finance in Common and UN Systems, Food Systems Networks. And so this is a platform that connects 150 national and regional development banks investing in agriculture, and they have a work stream on agroecology. And so, it's really about supporting these opening. Like, you're really looking at how we can support the kind of work that is happening in these institutions and encourage it to become more widespread.
Yeah, Kelly, please go for it.
Just very briefly at the end here, echoing all my fellow panelists have said, and I think that emerging national strategies, whether it's bioeconomy, climate, NDCs, I think there's a real opportunity here for policy to incentivize new financial models, innovations of various sorts, or maybe it's de-innovationing in some cases. And I would point again to your work, Nikki. I think it's such an interesting pairing of carbon markets done in an inclusive manner together with sustainable agriculture. I think is just brilliant, and that there are policies that may be more supportive of seeing that in a holistic way. So planetary boundaries with sustainable agriculture, with some ways to motivate financial capital to come in.
Amazing. Thank you so much to you all for your insightful responses. I believe there was a mention of planetary boundaries, and of course we've already transgressed, I believe, 7 of those planetary boundaries, and many of them are affiliated with the current way that we do food and farming. So thank you so much for bringing that perspective of hope. One more question that I would like us to take before we go into the closing remark. This question was actually asked by Lassie Brun. I hope I pronounced your name right. And the question reads, given the shifting geopolitical landscape, is there a rationale for shifting focus on engaging much more with, for example, African Development Bank, the Asian Development Bank, and establishing annual gatherings in those regions, as opposed to being focused mainly on the World Bank and the IMF, and of course their spring meetings? I don't know if that's clear, but then you had it in other words, helping to push the inevitable geopolitical shifts and push for leadership in global majority regions on sustainable agriculture. I believe the question is largely, should we focus on the regional development banks rather than the World Banks and the IMF in terms of scaling the transitions?
From a ground up perspective, that makes a lot of sense. I was actually typing an answer, Lasse, in the chat, where I think there are over 500. This is from Colin Anderson's work at University of Vermont. Over 500 public development banks. Can that be true? Worldwide, deploying, I think, 2.2 trillion annually, 10% of global finance. And so, yes, to engage these institutions in the places where they work and develop the kinds of relationships that we've all talked about to work together is absolutely essential, and could cascade into these broader reforms, especially as we see proof of concept for the investments. And the Nicola, the work that you described is a great example of this. And Kelly, you also had some really interesting examples of very concrete projects.
Thank you so much, Lauren. Would any of the panelists also want to jump on the question? Apologies, I can't see the main screen. Otherwise, I believe there was one question to Nicola. I don't know if it has been responded to in the chat. I believe it was to Lauren, and the question was, do you believe private sectors would be interested in investing in scaling sustainable agri-food systems when largely majority of their profit comes from the industrial agriculture?
We're doing work at the Global Alliance for the Future of Food to think about how divestment and investment strategies can work in a complementary way. So absolutely, we need to divest from the most harmful practices. And I do think there's growing interest. I mean, we see it all the time. Maybe there's a pipeline problem. Maybe there's, we have different language to describe the problem, a bankability problem. But we also have really vibrant examples of agroecological entrepreneurs that are able to attract the level of capital that they need to grow their business. I think people think of scale in different ways, but grow their business in ecologically and contextually appropriate ways. And this is the kind of investments we need to look for. It's harder work probably to make 10 investments of $50,000 to $100,000 than one single investment, but the kind of decentralized fabric and mosaic of businesses and entrepreneurs exist out there.
Amazing. Thank you. Thank you so much, Lauren. I see we only have 2 minutes, and there are still lots of questions that we've not been able to go through, but we are hoping to respond to some of these questions in the chat. If the panelists are able to do so, to sort of respond to some of these questions in the chat, that would be helpful. But then, just to wrap things up, again, thank you so much to all our panelists, and of course for the insightful presentation from their end. And as we conclude today's discussion, I believe that a few themes actually stood out clearly. And the first thing is food systems sit at the center of some of the defining challenges of our time, from hunger and nutrition to climate change to biodiversity loss and rural livelihood. And the second thing we've established is that development finance institutions have enormous influence in shaping how food systems transitions evolve. But then achieving these transitions will require more than simply just increasing agricultural finance. It will require us to reorient financial flows towards food systems that delivers on multiple outcomes simultaneously. And that means we need to align agricultural finance with climate and biodiversity goals. And then there is that need to also support agroecological and regenerative farming systems. And we need to design financial mechanisms that works for farmers and the communities. And also, we need to ensure that food systems transformation is guided by inclusive governance and evidence-based policy. So the conversation today makes clear that the transformation of food systems is possible. And given the examples shared by our panelists, we know that this transformation is already underway. But the challenge now is how quickly and effectively development finance can help accelerate it. And our panelists, again, have been immensely helpful in providing an inroad into how this can be done. So on behalf of the organizing partners, I would like to say thank you so much to all our speakers again for their insights, and to all of you as well for joining us for this important discussion. And I hope that you have a wonderful rest of your day or evening, depending on where you're joining from. Thank you so much again, and bye everyone. Cheers.